Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today we'll talk with Cornell chemistry professor, market watcher, and climate skeptic, and how does one say, modern philosopher, Dave Collum. It will be very interesting, I guarantee it. This week in the mailbag, a few questions about the recent down market, and one about our Costco recommendation, which we made available to all Stansberry subscribers last week. In my opening rant this week, I'll talk about the thing that's on everyone's mind. I wanted to talk about other stuff, but I can't. That and more right now on the Stansberry Investor Hour. Well, what's the thing that's on everyone's mind? Well, okay, I woke up this morning and I looked at my cryptocurrency account, and last night it was something like, I don't know, $96,000, and this morning it was something like 64. And I looked at that and I said, gosh, that's a lot less. So there's pretty much no way I can talk about anything else right now. But there's an interesting dynamic though, right? Bitcoin and other cryptos are crashing as I speak to you. And gold has perked up a little bit. It's actually perked up a lot. It's in the 1800s now, which is really cool. And, you know, we keep an eye on Sentiment Trader on Jason Geffert's website, sentimenttrader.com. He's a very, very well-informed investor. He spends all his time and energy looking at just dozens and dozens of sentiment indicators and anything like a sentiment indicator. So one of those things is the 200-day moving average in gold. And he says, look, when it gets above the 200-day moving average, it behaves really well. And when it's below it, you know, not so much. And it popped back up above it recently. So here we see, for some time, we've had people saying, well, gold is old school. It's a has-been asset. Crypto is where it is, especially Bitcoin is where it is. And that's all there is to it. It's all going to be different now. And, you know, I'm a Bitcoin bull, but I never bought that. I thought it was stupid. And I've always leaned heavily on the argument that gold has the Lindy effect, right? It's got a 5,000-year history. And Lindy says anything we've been using as a store of value for 5,000 years, maybe we'll be using it as a store of value for thousands of years more. There's a good chance of that, I believe. So to pronounce gold as kind of dead and Bitcoin as, you know, the up and coming replacement for it is a little silly to me. It's just a little silly. Bitcoin has what, a 12-year history or something? It's a little silly. And you can see, you know, they're wanting to hold gold, and they sold the daylights out of Bitcoin, you know, overnight as I'm speaking to you. So what do I think Bitcoin is a sell? Am I selling Bitcoin? Absolutely not. No. We said when we recommended Bitcoin in the Extreme Value newsletter, we said it was a long-term holding. We said, you know, what you do is you take a small amount of money, something you can afford to lose, something that you wouldn't miss it, you know, just some small amount of money, and you put it in Bitcoin and just kind of leave it alone for, I don't know, maybe for the rest of your life, but for many years, not just for many months. Okay, so, you know, we're a little over a year into our recommendation, and it's doing, you know, it's still up, even though it's down. It was down as much as 30% overnight. And even though that happened, we're still up a couple 100%. And I think over time, there will be a place for it in the global financial system. And technically speaking, of course, it's outside of that system, right? It's outside the global financial system. That's why it's so cool. And, you know, I recently went on Sebastian Gorka on his radio show, and And he said, Dan, what the heck is Bitcoin anyway? And I just, I thought I was half joking. I said, well, nobody really knows. And I'm only half joking with that because, again, it's this peer-to-peer cash system that was designed to eliminate the trusted third party in financial transactions, right? That's what it is, a peer-to-peer cash system. It's like Napster of money. So great. That's really great. That's a very specific kind of a definition. But when I say people don't know what it is, what I really mean, of course, is that we don't know where it will wind up in the scheme of things. We don't know if it will become, if there will be some sort of, Bitcoin 2.0 or something, or crypto 2.0, a completely new landscape of digital assets in the future compared to what exists today. And talk about a brand new thing in the world. 10 years ago, or we could go back to the time just before Bitcoin, say 12, 13 years ago, this stuff just didn't exist. And now there's a whole bunch of it, of course, and it's a huge innovation. The uses are potentially far and wide. Like, I can't even imagine what the world will look like in 20 or 30 years. Because it's that kind of a technology. It's internet level innovation. The internet has changed so many things, and I think crypto could do the same. And yes, if you're holding Bitcoin, you're going to have to ride out some, 30% overnight drops. That's just the way it is. But we're not selling. I'm not selling mine, and I'm not telling my readers to sell. Put it that way. And I'm still holding my Ethereum too. Those are the only two I own, Ethereum and Bitcoin. So we have an interesting rotation, sort of, a mini rotation maybe, because I think Bitcoin, the last I looked, the chart was straight down and then straight back up, a really, really sharp V. So maybe we've already seen the bottom temporarily. I don't know. And I don't really care, right? I follow my own advice. If it goes to zero, who cares, whatever. And that's the advice that I'm continuing to give. But I think it's really interesting. I never said sell silver. I never said sell gold. I never bought this whole, gold is no good anymore. Bitcoin is it, and gold is not it anymore. Never bought any of that. And right now, I'm really happy because my gold and silver are doing just fine. Thank you very much. And, my Bitcoin, I believe, will continue to do fine over the long term. So that's all I have to say about that. Before last night happened, the night before we're recording this, I wanted to mention what I think is kind of a typical sign of the time. Fidelity is coming up with these new accounts. They're going to have no fee saving, spending, investing accounts for 13 to 17-year-olds, right? So that it'll give parents or guardians, whoever, the opportunity to monitor the account, right? But otherwise, the 13 to 17-year-olds will be able to save and spend and invest, like in stocks, through their very own account. What do I think of this? Overall, I don't think it's a terrible thing at all. Now, the fact that it's happening at a time when the most incredible bull market in history, certainly the most overvalued bull market in history by some measures, is weakening, and the stocks are falling, and the big asset of the day, Bitcoin, is crashing. You could say it's a sign of the top, but overall, you notice when I interview people, for example, I always ask, were you one of these folks who bought their first stock when they were 10 years old or something? And I think it's a good thing. I think the more people 13 to 17 years old that we have being interested in investing, I think the more it's just better for all of us. Because yes, teenagers will be susceptible to animal spirits. But you know something? 1 in 10,000 or 100,000 or a million, I don't care. Somebody out there is going to be the next Warren Buffett, buying their first stock when they're 13 because they got a Fidelity account. And that's going to be good for all of us. Warren Buffett's existence has certainly been good for all of us. He's taught us a lot. And I think there's another one out there. And if Fidelity's making it easier to find him, maybe. Or her. I shouldn't say him. I should say him or her. The other thing that's similar to that I want to talk about real quick is, as a potential sign of the top, right? As a potential kind of sign of the times, an article in CNBC, and I've seen this other places, but I'll just pick on this one article. The headline is "Banks to Offer Credit Cards to People Without Credit Scores." So what they're doing is they're going to take into account information from a credit applicant's savings and checking accounts, which will in turn boost their chances of getting a credit card. And look, credit cards are not great. They're just not. But, I find it necessary to have one. My balance is like, $200 or whatever, and I'll pay that off in the next 15 minutes. But, just for traveling especially and buying things online, you get some free insurance along with most credit cards. It's just a good thing to have if you manage it and use it responsibly, of course, right? And making credit cards more available, again, it's double-edged, isn't it? Because you make more credit available to more people who didn't have it before. Well, a lot of them are going to misbehave, aren't they? They're going to abuse it. They're going to go bankrupt, right? But overall, you're sort of greasing the wheels of commerce, and you're making the world more available to more people. So I think they are both, the Fidelity teenage account thing and this, they're both signs of the time, right? A few weeks ago, we talked about the Goldman Sachs Financial Conditions Index, and it was like financial conditions were looser than ever. It's easier to get a loan than ever. And this is a sign of that. But I've tried to learn to see things in a balanced way. And not everything means the market is going to crash tomorrow, okay? So there's a lot happening right now. And it's probably really difficult to wake up every day, to wake up one day and find your Bitcoin down 30%. And stocks aren't doing great as I speak to you. Like not all of them, many of my put option positions, which, the numbers next to my put options are always red. But many of them are green today as I speak to you. So it's a difficult time for a lot of investors. But, Chris Mayer, who I quote every now and then, just a friend of mine from a long time ago in the newsletter business, he likes to say right now is always the hardest time to invest. And I think that's always true. And it gets harder when asset prices don't behave the way everybody wants them to. But I don't think you should be doing anything different. I mean, what have I been saying? Well, make sure you hold plenty of cash. Make sure you hold some gold and silver. By all means, hold on to your stocks and bonds. You need to have a stake in the ongoing betterment of mankind. And that is what your stocks and bonds are. So, I've always counseled this balanced portfolio. And I said also, buy a little bit of Bitcoin. So if you just bought a little bit, you don't really care about down 30%. If you held plenty of cash, you're really happy about that right now. Maybe you're looking to buy really great stocks today. That would not be a bad thing to do at all. And, if you're holding your gold and silver, hey, they've come to life recently too. So you got to learn. I think these times of ours with asset prices having been so elevated, you can't afford not to have that more nuanced, more balanced approach to your personal asset allocation. I've said that 100 times, so I won't say it one more. We've expected this kind of turmoil. I've been talking certainly about stocks and bonds not doing so well for some time, and that's happening lately. And, I always said Bitcoin traded like a biotech stock, and, it's trading like a biotech stock. So none of this is really surprising to me or, maybe to you as a listener of Stansberry Investor Hour. So it's worth talking about what's happened in the past couple of days, but it's also worth saying, hey, we're not surprised, right? All right. That's it for now on the rant. That's all I got for you. Before we talk to Dave Collum today, I want to do my quote of the week. I was reading through a book called Capitalism Without Capital, The Rise of the Intangible Economy by Jonathan Haskell and Stian Westlake. And I came across this one quote. It seems really simple, but I think it's really important. It says, gross domestic product is defined as the sum of the value of consumption, investment, government spending, and net exports. Of these four, investment is often the driver of booms and recessions, as it tends to rise and fall more dramatically in response to monetary policy and business confidence. The investment element of GDP is where the animal spirits of the economy bark and where a recession first bites. I'm going to say that last one again. The investment element of GDP is where the animal spirits of the economy bark and where a recession first bites. That's by Jonathan Haskell and Stian Westlake from their book Capitalism Without Capital. And it's really interesting because we talked maybe, I don't know, within the past month or two about how in the dot-com bust, the market fell apart before the fundamentals underlying those businesses, before the growth. It was a very growthy investment thesis. It's very similar to what we're seeing today, right? Hyper growth companies like whatever, Tesla or I don't know, take your pick. There's too many of them. Hyper growth companies that maybe even don't make money garner huge market caps, right? Huge growth multiples of revenue, multiples of earnings, whatever. And they're obviously very, very overvalued. But what happened in the dot-com with that phenomenon is that the growth multiples fell before the growth fell, right? And I think that may be what we are seeing right this minute as I'm speaking to you. We'll see. We'll see where the markets end up at the end of the year. Right now, they're not doing so great. Let's talk with Dave Collum. Let's do it right now. Every week I tell you I'm the editor of Extreme Value, published by Stansberry Research, but I don't usually say anything more than that. Well, to my dedicated listeners who are looking to find incredibly valuable long-term investments, I'll tell you right now, my Extreme Value newsletter is a monthly publication that focuses on buying safe, cheap stocks only when the price is right. And I'm not over-exaggerating. Extreme Value picks have earned one of the most impressive track records in the industry. Mike Barrett and I spend hundreds of hours each month poring over balance sheets and SEC filings to find stocks trading at huge discounts to their true worth, giving subscribers a large margin of safety on every pick. You can learn more about that or sign up for the newsletter at investorhourdan.com. So you can support the show and find some of the most profitable ways to invest all at once. investorhourdan.com. Check it out. Today's guest is Dave Collum. And I should welcome Dave back to the program because he's been with us before, and I told him he'd be invited back, and here he is. Dave is the Betty R. Miller Professor of Organic Chemistry and Department Chair at Cornell University. If there's such thing as a big-time chemistry professor, Dave is it. He is also a staunch libertarian, fan of the Austrian business cycle and gold and other similar things. Dave, welcome back to the show. It's been too long.
Hey, glad to be back. I'm no longer department chair, just for the record. I did 4 years and out, and now I'm just an over-the-hill has-been.
Oh man, I said you were big time. You're not big time anymore.
Yeah, I'm overtime. Overtime.
You're overtime. All right. So, Dave, with other guests, I feel the need to sort of hone in on a particular topic and know a lot about it going in and do a lot of research. But with you, somehow, I feel, partially because we're birds of a feather on a lot of these topics, we're similar mind. With you, I feel like I can just start out by saying, what is most on your mind these days? If that's too general a question, let me know. But what concerns you? What are you worried about right now? Anything in particular?
You mean besides 10% annualized inflation? I've been obsessing a lot over authoritarianism. I think that when Biden was elected, his calling was to unify the country and try to get us to go back to being calm and collected. And I thought he'd pivot to the middle. I said so last year when I wrote about it. And he's done nothing of the kind, which I find deeply disappointing. And it feels like that they're putting into position all sorts of things to attempt to squash their opponents, their political opponents. It feels like a bit of a putsch. And so I've been worried about stuff like that.
Yeah, I've heard him called the most progressive president either in history or since FDR. Both of those.
Yeah, I'm not sure I call it progressive, but yeah.
Yeah, right. Progressive in quotes, right?
Yeah, air quotes, yeah.
Yeah.
So, yeah, that's what's been bugging me. I had a discussion this morning about a guy. We got into autism, and I'm a vaxxer. I'm a total vaxxer. Vaccines save lives, but I did run across some evidence that there could be a vaccine autism link. And I got into a discussion. We got into the debate about, okay, let's say there does exist such a thing, and I'm not supporting it because I've literally been on this topic for 24 hours. How many sort of catastrophic autism cases do you accept as just part of the cost of making the populace in general healthy? And what I said is, look, I don't know what that number is, but I do know that I don't want them lying to me. And if they know that there is a connection, even if it's a 1 in 250,000, I would like to hear that. I don't want authorities. I don't want to go to the CDC or the Mayo Clinic and have them say there's zero. And there could be zero. I'm not joining the Vaxxer team yet, but I did get rattled by a video someone sent me. So now I'm thinking about it. But I don't want the big lie. There's a lot of big lies right now, and I'm getting exhausted by those.
What's one of the worst big lies that you see right now?
Climate change.
Climate change.
Yeah, climate change.
We can talk about that because I personally, I'm not a scientist, just, I put it out there, but the tone of it is so bad. I know it's irresponsible to suggest this, but still, the tone of it is so bad that it's kind of a tell. So that may bias me when I look into it, but the more I read, the more it seems like, the key data sets have been screwed with, or it seems like misinterpreted on purpose almost. Mm-hmm. And the whole thing, it just has this. And for example, the consensus issue, right? The consensus issue where they say 97 or 99% of scientists agree on this. It seems to go back to this woman, Naomi Oreskes from Harvard, who did what I consider a really irresponsible thing. She just read the abstracts of a few hundred papers and gleaned from the abstract alone that there was a consensus.
Well, it was worse than that. It was worse than that because she took 11,500 papers and looked at just the abstract, which I'm okay with. Who wants to read 11,500 papers?
Right.
So I'm okay with the abstract, but then she called down those abstracts to papers that had a definitive statement about climate change, and that called them down to 99 papers. And I don't know whether that included papers from the same author. I don't know, but let's say 99 independent authors, and 97 of them said climate change was a problem. Well, that's a terribly bizarre way to do it. And so to backtrack, if you'd asked me 3 or 4 years ago, and I have an email trail showing this, I actually wrote about it. I used it in one of my writings on it. You asked me 3 or 4 years ago, I would have said, yeah, sure, climate change is real. And I've, over the years, asked many people, well, what do you think? Because I was unqualified. I mean, I had no reason to think I knew. And they all would say, yeah, I think it's real, and I think it's acute, and this and that, different fields, different scientists, that sort of thing. And then I started to notice that, so my brother pushed against me and said, how do you know it's real? And I said, Ned, every scientist I know believes it. What else can I say? And then I had another guy sends me emails, push back at me again, and I gave him the same answer. And I said, I don't think there's any credible scientists who don't believe it. And he said, oh, yes, there are. And so he sent me a list of a bunch. So my first thought would be, well, these are going to be a bunch of guys from who the hell knows, studying who the hell cares. And therefore I won't give a damn about their opinions. And it turns out it was not that. They were pretty elite looking scientists, Harvard, MIT, Stanford, Princeton, Caltech. And then I said, okay, but here's what's going to be the case. They're going to be guys who picked on a climate model, as we all should do, and said this model's wrong. And that's being interpreted as climate denying. And so I started Googling them, and that's not what I ran into. I ran into very, very prominent physicists and geologists and stuff who were saying, no, the story's total crap. So I wrote one year, I think it was in 18, I wrote a little bit of an essay in one of my annual reviews that I do saying that I don't know, and if I had to guess, I'd say climate change issue's real, but the consensus model is wrong. And I have colleagues who are as ignorant as me who seem unrestrained by this ignorance and willing to say, yeah, climate change is real. And so the populace who says, oh, Dave's a PhD in chemistry, he must know, therefore he says climate change is real. I don't know anything. I didn't know anything. It was just, my opinion was irrelevant. I told the Secretary of Energy I was agnostic on it, and he flinched. And I said, it would take me 10,000 hours to figure that out. So colleagues who I think were believers pushed me, said, you've got a huge platform, you should dig into this. So in 19, I dug into it. I spent enormous amounts of time reading about climate change, and I kept running into just cockeyed narratives. It took me probably 20 hours of reading to figure out that something was wrong. And then hundreds of hours later, I said that there's just so much lying and so much conflict. There's $1 trillion climate industrial complex that won't exist if climate change is a dud. And then you start running into all these famous scientists who are saying, look, there's no evidence to support this. And then I just happened this morning to be reading a Wall Street Journal op-ed saying that Facebook has squashed their book report on Steve Koonen's book on climate change. So who's Steve Koonen? Steve Koonen is a Caltech physicist, former provost, former Obama's top scientific advisor, saying that when you read the climate change reports from the IPCC and you read the literature the media talking about it, they're unrelated to each other. The reports do not tell a horror story. The IPCC reports do not tell a horror story. He said the media is telling the horror story. And so you just find just lie after lie after lie. And after a while, I said, this is crap. This is total crap. And every once in a while I get sucked into reading some more. But at this point, it would take kind of an act of Congress to convince me that this discussion is anything but a polluted swamp of crap.
It is a polluted swamp, and it seems to get worse. It doesn't get better. For example, Facebook, you're talking about Koonen. Facebook squelched a Wall Street Journal review.
Right.
I think you retweeted about this of Koonen's book.
Right.
So, I mean, when you're not allowed to review a book that leans a certain way, and sure, I understand, Facebook is owned by Facebook. It's not the government or Fox News or whatever, but still, it's a huge platform.
Well, we can even discuss that. Do they really have the right to squash something? And that gets to that whole Rule 230. And are they a media? Are they a media? Or are they a platform? And they can't be both. And they're acting both. They're having their cake and eat it too. But so in any case, the climate change story is not going to go away. Koonen is having a terrible time getting even any face time. This is a Caltech provost, this scientific advisor to the president saying that it's not catastrophic and it won't be catastrophic and that the models are highly flawed. And he goes through, in his book, apparently, it's next on my reading list, but as he goes through the models and says, here's how flawed they are. By the way, recently a Stanford physicist went through the models and said their projections have error bars that are 5 times the size of the projection. Scientifically, that means it's an irrelevant projection.
It's worthless. Yeah.
It's worthless. Yeah, it's worthless. And so, but this is going to be a multi-dozen trillion-dollar feed trough, not unlike, the kinds we're getting now, which leads us to the next concern I have. We got massive inflation brewing, and we've got a government that now thinks that every 6 months they should drop $2 trillion somewhere. And I see no reason why they're going to stop. I see nothing that will stop them, because there's $2 trillion worth of recipients who are going to go give us another. We love that.
Right. And my concern there is, technically speaking, it's different when the Federal Reserve prints money, or, as they say, marks up the account and simply swaps $1 of reserves for $1 of income security. That is one thing, right? Mm-hmm. That is one thing. It is another thing when those income securities are just wholesale dumped on the market by the government for the purpose of being mopped up by the Fed. That's monetization. And that's where we are. And we got there. We didn't just get there incrementally. We got there, boom, trillions worth. In this short time frame that the situation has existed, people have begun to talk about inflation. But, had this amount of just call it money printing, or, Fed balance sheet increase, or whatever you want to call it, occurred, I believe, over, let's say 5 years, I think the narrative about inflation would be much louder, much louder.
Well, we're currently sitting this morning looking at a situation where we've got 10% inflation and gas stations in the country out of gas. Tell me what decade that reminds you of, right? That sounds like the 70s to me. And we've got a Federal Reserve that's saying that inflation is going to be transitory and makes claims about it being 2%. No one believes 2%. So the age-old question is, are they stupider than a brick or pathological liars? I don't know which it is. I go with the combo platter. I think they're both. And Bank of America came out. This is the most absurd thing I've ever heard. Bank of America analysts came out and said we're going to have transitory hyperinflation.
Yeah, I saw that.
I go, what is that? And then I think about, oh, right, Weimar Germany's hyperinflation lasted about a year, because it's a big mushroom cloud, and it destroys the economy. Hyperinflation doesn't last long ever.
Sure, right. It blows itself up pretty quick.
Yeah. So baby Bank of America is saying we're gone. And then yesterday, and I think this must have sent a chill through Wall Street and through the Fed, Druckenmiller wrote a Wall Street Journal op-ed, and he destroyed the Fed. He utterly took them right down to the studs. So if you guys haven't read the Druckenmiller Wall Street Journal op-ed, I could not have done a more ferocious job, and I worked very hard to criticize the Fed.
Yeah, I saw comments that he had made. I didn't read the op-ed yet, but I saw comments that he had made. I think it was on CNBC, that were extremely critical in the same way.
Yeah, the op-ed's even worse than the CNBC interview.
Okay. I'll just take a look at it, and then maybe I'll talk to our listeners about it. The funny thing about Druckenmiller, though, I do have to say, he's a strange guy to listen to, because while I always take him seriously, I also know that he's never married to a prediction or an opinion. And if the market changes on a dime, he's changed on a dime as well. So
yeah, but I think that's the trader in him. So I think that he has the flexibility of a trader, but I'm not sure that flexibility translates into his macro. So Druckenmiller can be one of these guys, sort of, who's the ultimate of this? I think it must be David Tepper. And David will make a trade, and it has nothing to do with whether he thinks it's good in any sort of medium term. He just knows that thing's moving today. And so David Tepper will see something moving in the right direction. He has an unbelievable sense of market movements. And I think Druckenmiller has that instinct too. So I think Druckenmiller can simultaneously say I'm bullish on stocks and the market's a bubble. I think that those are self-consistent in on his time scales.
Yep, that's right. It is. Stocks are a bubble, therefore I'm long would be
They're
a
bubbling.
classic.
They're bubbling. Yeah, don't miss the end of the bubble. It's heroic. It's spectacular. I don't do that. I can't do that.
Well, it's really hard. I demonstrated this once in my newsletter. Like if you're trading around the top, you damn well better be Druckenmiller, because usually, in almost every case I've ever looked at, the volatility is so ferocious. When you think you've gotten confirmation, you're just about to get whipsawed back out in both directions. So, and you don't know. Nobody knows that it's the top. It's just a really volatile time.
Yeah, so here's the irony of the top. The top represents, according to the pricing of let's call it equities, just there's a top in bonds too, but the top represents, as indicated by the price, the period of maximum optimism, right? So people are willing to pay more. It means that they're more optimistic. And so there's this odd irony where on some fateful moment on a Tuesday afternoon at 2:03 p.m., that the market reaches the point of maximum optimism at the very instant that the justification for the optimism is 0.0. So those secular tops are invariably paradoxical. And it's the same with the bottom. The market reaches point of maximum pessimism at the very instant when it's nothing but up from here. And so you can be right by going with the market in the middle, but when you're at the top, the market by definition has it wrong. And when you're at the bottom, the market by definition has it wrong. And so I've been trying to figure out how to protect cash. And I've always been comfortable sitting on a large cash position for quite some time. And I've done fine because I've owned gold and I rode energy from 01 up. That was actually a pretty good call. It was just an inflation hedge for me, but it worked. But last year convinced me, the bailout packages convinced me, and the Fed's actions convinced me that they feel unrestrained completely, and that there's nothing that they can't imagine doing now to try to protect the price of assets. And so then I think at one point the Fed was kind of predictable. You could say, look, when it gets frothy, they'll start, raising rates. And, there were certain things you could kind of count on. I don't think you can anymore. I think those old metrics are gone. I think they now think that they can drop trillions and trillions without a cost. And so they have no guardrails. And as a consequence, therefore, now my belief that a big cash position waiting to buy distressed assets when there's blood in the street, or the blood in the street's dried up and blown away, whatever metaphor you like, is maybe not correct. So nominal returns could just keep going up while inflation ravages the investments. So I'm laboring over what to do with cash positions right now. A big one. I did the math this morning. I think I must have 12 annual salaries in cash, and that's a lot of money.
That's a lot of cash. Yeah, cash is a difficult one when inflation has taken hold, because you don't want to buy the wrong assets either, right? Because you'll get hit there. So, but if you want to get a steady return, most people turn to bonds, maybe stocks.
Well, those
Inflation's
are gone now.
Bad. Yeah, right. Inflation is bad for business. Inflation is horrible for bonds. So then what are you left with? It's difficult.
Not only that, but the bonds, you not only look at capital loss in bonds, you're flat out losing money.
Oh, yeah.
Your return is negative. So
sure, but you start from yields like we have
broken
now, right?
Yeah, the bond market's completely and utterly been destroyed by artificially low rates. And so now your 60-40 portfolio, 40 is guaranteed to lose you money, in my opinion. We can have a deflation where it doesn't lose you money, but on the current path, it's guaranteed to lose you money. I would argue the equities are guaranteed to return very little, integrated over a long period. I think from these lofty valuations, there's no way to hide. So I'm looking at things like, there's a few things that I've bought lately, in part to try to cut the cash back a little, even though this could be, Druckenmiller lost $1.5 billion right at the end of the dot-com bubble. because he held out, and then he lost his mind and said, God damn it, I got to buy him. And he said he top called it within hours of the top. He said he nailed the top within hours, and he lost $1.5 billion with Soros, and he ended up resigning. So the top is when Stan Druckenmiller gets sucked in. And so maybe this top is when, not to equate myself with him, maybe I'm the last bear. And once I'm in the pool, they'll throw that toaster oven in. But I'm looking at things like Rio Tinto, which looks pretty decently priced. And it's kind of a play that the climate change guys will keep control and use a lot of resources trying to build crap. And it's good dividend, no debt. Things like that. I used to hate mining shares. I used to hate the miners because I think
it's a terrible business.
Well, it's a terrible business. And guys who I really trust would say these things are dirt cheap. And I'd look and there's no cash flow. They're not making money. And I go, how do you define cheap? I don't understand what you're talking about. And they start babbling about reserves. When I was at one of your conferences, there was a CEO of one of the mining companies there. And I told him, I said, you guys totally screwed the pooch. Gold went up fourfold, even though it regressed from 1900 down. You saw it a fourfold gain. The miners didn't do anything. They didn't make any money. How do you blow it that badly? And he said, yeah, we did a terrible job. The whole industry did a terrible job. So I ignored miners. I haven't had miners for a long time. And then I was listening to Fred Hickey one day, and he started citing some of the numbers on miners. And I'm going, holy cow, these things sound like tobacco stocks now. So I started digging in, and you can find decently valued gold mining companies with cash on the balance sheet, net cash on the balance sheet, and cash flows and dividends. And these things look like real value plays, not just we have gold in the ground. I live on a lake. I fish in the lake. So what? And so I started buying some of the miners, and I found a real little gem that's just phenomenal looking. I've undersized it, but it's a small cap in Brazil that no one seems to know about. I've asked a bunch of people, and they all say, no, I haven't heard of it. And then I found out that Eric Sprott owns half of it. I go, that's good. And Jim Grant recommended it. I go, that's good. So, I'm finding some bargains in the miners.
Yeah, the industry actually got some religion the end of this last cycle. It's similar to what happened it happened to a certain degree with airlines, and before that it happened with railroads. Over time they do such a horrible job, they destroy so much capital, and then somebody figures out, something, not generating $1 of free cash flow for 20 years, even through a huge bull market in gold, it's kind of bad. So, we need to fix that. It's horrible, actually, yeah. But I think they are now. That's the key. I think they're a good buy. And again, I'm going into energy. I'll tell you what tipped me off on energy. I've always kind of liked energy, right? You got to fuel the world. I don't see how it goes away. When they booted Exxon from the Dow, I sat right up and said, holy cow, that sounds like a bottom call, doesn't it? It's like the magazine Barron's cover that said, is Amazon a $12 stock? And so I looked at the Dow, and they booted him. They replaced him with Salesforce.com, which is just garbage. And I said, holy cow, energy really is being thrown out now. And so I did a little quick checking. It turns out the S&P's was a little over 2% energy. That is one strange world to have the S&P 2% occupied by energy companies. And so I started moving into energy as an inflation hedge again for the first time in quite a few years. And I'm a little nervous. If we have a secular bear, I know I'm going to get beat up on the stuff I've moved into. So I'm doing it incrementally. I'm positioning it poorly. If these things run hard, I'm not going to change my life because of them. I'm not doing a Texas Hold'em on these things, but I am buying them incrementally. I might even play a little trading game. If I start to see what I think is a secular bear and the entities start to give out, I might sell out of them and say, if I have to get back into them later, I will. I don't know. I don't trade, though. I'm a 10-year guy. Right. So when I hear energy, I think oil. And when I think oil, I think, well, in this country, 2/3 of the oil is used for transportation. And one of the implications of all this climate stuff that you're talking about, the $1 trillion sort of climate industry, is electric cars. Right. And I have to give electric cars their due, because on the face of it, whether you care about climate or not, there is something more efficient about, reducing the number of moving parts by 99%. That's got to be a good thing overall.
I guess
there's
so.
an efficiency there.
Well, I guess so, but you have to convert energy to electricity to the movement, whereas from gasoline, you go straight from energy to movement. And so, so part of my thought is, what's the proper fossil fuel play to handle the electric car shift? My suspicion is one could make the argument it's a coal play, but I'm not sure we have it in us to do coal. I know China does, and I know other places do. Natural gas strikes me. And I'm also buying, there's a mutual fund, I can't even remember the symbol for it, a small one, a boutique. Guys, Rosenzweig, and is this going to ring a bell with you? I can probably get it here. It's a boutique play that does natural resources with a strong emphasis on nuclear. And so I kind of have tiptoed my way into that company's mutual fund. There's a small cap guy I really like. I've been in communication with for years, and I finally started to put some money into his fund called a guy named Eric Cinnamon. And I think he's really good at looking under the hood of the small caps and finding the ones that really are well priced. And he's not bashful about sitting on piles of cash if he doesn't find what he likes. So that's a good sign. The energy mutual fund is called Gehring and Rosenzweig Resources. It's GRHIX, in case someone cares. I don't personally know how to play the uranium game. I know guys like Rick Rule love uranium, and I like Rick. And so I'm betting long term that the green world will finally realize we got to go nuke.
Yeah, that seems like the greenest thing of all. And green, every time I say greenest, it's a non-starter, because if you really want to green the planet, you'll fill it full of hothouses and build and get CO2 generators to crank it up to 1,000 parts per million.
Absolutely. But the term green still has enough meaning to it, enough irrational meaning to still be able to use it. But you're right. CO2 is not a pollutant, right? CO2 is plant food.
Right. That's how the planet is greened. It is greened by CO2.
It is getting greener too. It turns out that the actual measured plant material is growing.
That's another one of the fake data bits, is they keep talking about some optimal level of CO2, like between 300, 400 parts per million. And, there's a reason why. Yeah,
not a clue.
That's right. Nobody knows this.
So I'm supposed to give a talk at an investment conference. I'm thinking of giving a climate change talk with, at the finish, trying to pull it together and say, and this is what I think you ought to be buying. I'm nowhere near, I don't know this stuff well, so I'm kind of a sector player. So in 2001, I said energy, that's about as deep as I get. It would be like in The Graduate buying plastics. And I can't read balance sheets to save my life. I can just look and say, oh, look, there's no debt. That's good. I could say, look, their payout ratio is 20%. That's good, right? But I can't dig into a balance sheet and really find out about the cash flows in detail and stuff like that. So I just have to do a kind of a Peter Lynch thing where I said, look, buy every damn bank if you think banks are going to do well.
Yeah, that's right. That is a very Peter Lynch move. And especially with that sector, I know he's done that. We've talked about climate. We've talked about inflation, talked about the Federal Reserve. And real quick, I meant to mention to you, for me, the dynamic with the Fed is it's an addiction dynamic, right? There was basically $1 trillion or so out of the financial crisis, and then now it's multiple trillions, and they're pushing, pretty soon they'll realize they're pushing on a string, and the more trillions you get, the less reaction the market will show them.
But I do think I think there is a ceiling above them. I don't think they can do this forever, because I do believe, the Fed also babbles incoherently about inflation expectations. And if you look at some of the writings of Rogoff, he talks about inflating away debt. And he says one of the critical things is you have to do it covertly. Because once the system picks up on the inflation and it starts adjusting for it, you just get more inflation. And because people start adjusting prices accordingly. Well, we're already there. The Fed has already lost that narrative completely. So they can say 2.5%. Again, this morning's print was annualized 10%. And so inflation expectations are off the chart, almost to the point where you can say it's a bubble. We're going to get deflation from some bust, right? But the Fed's losing its credibility in a very big way, in my opinion. Right up there with the CDC losing its credibility in a very big way. And I think we're in a crisis of authorities. And this is a conversation I have a lot. I like to ask people, name an organization, a 3-letter organization that you trust what they say. So it's not the CIA, right? It's not the FBI. It's not the World Health Organization, right? You can go through a whole list. And someone finally gave me the answer I thought was really funny. They said KFC. I said, okay, KFC. So we really have a crisis. You reach a point where you say, well, how do you even know what's fact and fiction anymore? Because there's no authority. I can't go to the Mayo Clinic website and find out about the cause of autism. Again, this autism issue is 24 hours old for me. I completely ignored it. But if I go to the Mayo Clinic, the one thing I know positively, no matter what the real story is, they will not say it's a vaccine. They can't say it's a vaccine. They can't even say 1 in 100,000 is due to the vaccine. And so where do you turn? Well, you end up watching off-Broadway videos and stuff from people saying it's a vaccine. So we don't have a way to get facts anymore because the facts are getting so garbled up in narratives, and articles by Steve Koonin about climate change are getting suppressed. And Michael Moore made a documentary about climate change and came to the conclusion it was the climate change industrial complex that was the problem. And what happened? They booted it off YouTube. They suppressed all the writing about it. Michael Moore, the darling of the left, could not get his video seen by the world. It's called Planet of the Humans. Find it, watch it. It will show you that the climate change industrial complex is a massively corrupt organization at this point. But it's a crisis of authority. Who do you believe? I believe Stan Druckenmiller.
Yeah. When it comes to the Federal Reserve, few people have watched it as closely as he has. But of course, at this point, the balance sheet movement is so enormous, like you can only miss it if you're walking around blindfolded. I mean, you don't need an expert like Druckenmiller to tell you what's happening because, if you can't see it, maybe, get out of the house once in a while, right?
Well, what I'll tell you is tricky, though, is to actually know the consequences of the Fed's balance sheet.
Sure. Yeah.
So I think what's more telling to me, for example, are metrics of leverage in the system. So the Fed's balance sheet could be high without a lot of leverage. And that just means that the reserve assets that they're putting into the system. So you hit upon this well, although I think a lot of people don't get it. When the Fed buys treasuries, they're really not printing wealth in any way. Forget about the fact it's not wealth, but they're really swapping a duration asset, a zero duration asset for a long-term duration asset. So now the banks, instead of having a treasury, which is as good as money, essentially have cash. The difference being is the cash functions as a reserve for lending. They don't lend the cash, they lend against the cash. But it's a reserve, and treasuries are not reserves, which is the odd thing. And I think they're even talking about making them reserves so the Fed can stop doing this. But so in theory, the banks, when they have a wad of reserves, can lend a lot more. And then as soon as you lend, it creates more reserves. And so the whole system levers up like crazy. But the banks seem to be not levering up as much as they could, but the leverage in the system is still, I think, unprecedented. It's very hard to track because you got the shadow banking system that's hiding huge leverage. No one knew, for example, what's going on with Archegos or however you pronounce it. And the corporate debt problem is massive, and obviously the sovereign debt problem is massive. And so I think at some point all this debt will in some way unwind, either via transitory hyperinflation. I'm not a hyperinflation guy. Hyperinflation really is about a failed state. It's not just inflation. It's where complete dysfunction has occurred. And I'm not. That's a low probability bet, especially for a first world country. Forget Weimar Germany. But high inflation sure as heck is coming, I think, if we don't get a big deflation. One of the two is coming, in my opinion.
Yeah, I would say that I don't like to get into the game of predicting the future at all.
No.
But you better if you're not prepared for inflation right now, you're making an enormous mistake.
Right.
Yeah.
And I am. So for those who, I have a large cash position, but I'm also 30% precious metals. And I own a house that's about 3 times as expensive as I need, but it's a life-changing existence. So it hangs off a 100-foot cliff looking west right over Cuba Lake. It's right at the lake edge, 100-foot high, 350 feet of deck, a hot tub. I mean, I live like a king. And if it would ever warm up, I'd be sitting out on my deck really enjoying it. And that's a bet that the house can track inflation. Not win, not beat it, not make me money, but that it's such a kind of a real estate bet. Admittedly, it's only, I did the math the other day, it's like 8% of my assets, but it's more than I needed. So I'm pretty hedged against inflation. Put it this way, if we have inflation, I get hit, I don't know what's going to happen to everyone else. The Bitcoiners may be okay. The hodlers, as opposed to the goldlers.
Right. I think the bet on the house is pretty good over time. You know, it has worked out that way.
Well, Thornburg says you get about 0.7% above inflation. If you add in everything, you throw in absolutely everything into the cost of owning a house, you get about 7%. 0.7%.
0.7% plus an enormous amount of utility. So that's not.
That's right. And that's what I bought. I did the math. I said, look, I'm going to pay 3 times as many taxes over 30 years. This is how much it'll cost. Are you okay with that? Right. So that's the math I did. And I said, yeah, sure. This will be a nice way to spend the rest of my life. So I did it. And I also was in a huge cash position. I had no exposure to anything but the gold and the cash, pretty much. I, by the way, have a fixed income retirement account with quite a bit, which I call cash. It's interesting. It's a guaranteed, be careful, Dave, but I think this is a pretty good bet. It's guaranteed 3%.
3% nominal. Be careful with 3% nominal.
No, I know, but try to get 3% nominal without going to Argentina, right? What's the treasury give you? What's a 30-year treasury gives you? Who in the right mind would buy a 3% treasury for the coupon? A 30-year treasury for the coupon. By the way, rates are rising this morning. I just noticed they're not liking what they heard today.
Right, and yet, to my point earlier about the speed with which the Fed balance sheet has grown in this episode, still here we are with rates rising today. We're around below 1.7% on the 10-year, still below 2.4 on the 30-year. And
right.
Both of those for yield bets, they're horrible, right? You're in negative territory, right? In real. So still, why aren't we 5.6? That was part of Druckenmiller's bit on CNBC. He was like, we get to 4.9 or whatever on the 10-year, I think he was referring to. All of a sudden, a third of the federal budget is interest payments.
So the question I like to ask people is, I say, imagine that there's a 30-year bet you can make. We'll call it a treasury. That you are guaranteed you will be paid the interest rate. You're guaranteed you'll get your principal back, right? Forget about whether this is true or not. Guaranteed. And that what you can't do is you got to hang on to it for 30 years. And you can't hedge it, which is trying to get the bond traders out of my head. So you just got to buy it and hold on to it for the coupon. What interest rate would you demand? not knowing what the next 30 years is going to bring. What interest rate would you demand to tie up money for 30 years?
More than 2.4%, I'm going to guess.
More than 2.4. And it would be, in the very least, high single digit.
Yeah, at the very least.
And therefore, the bond market is priced wrong. I know one guy who has said, I think bonds at this price will pay off positively over the next 30 years. I know one guy, he's not a stupid guy, but everyone else says, no, you don't hold bonds for that long. You don't hold them. You just buy them until you sell them. I go, that's just trading, dude. That's not investing.
Yeah, I'm still waiting for Lacey Hunt's narrative to change.
Lacey's so smart that I pay attention to what he says.
Absolutely. And he's still talking about deflation.
I know. He's one of the guys who called that pretty well, although we all seem to think that the real inflation rate's higher than the stated rate, of course. And so
right. But he was doing it for practical considerations, and they nailed that trade, right? I mean,
yeah, absolutely. At some point, Lacey will be wrong or will change his tune. But at some point, this 40-year bond bull market's going to end, and it's going to be an epic turn of events. It won't necessarily be instant, right? But it as we march back up, we don't have to march up very high before the system really starts breaking, because there's so much leverage in the system. So where do you think, if I were to tell you, 2 years from now, the rates will be X percent, what's the value of X that you would say we have had a catastrophe? How low could X be to say this would be catastrophic? On the 10-year. Where would you say, holy cow, if I had a crystal ball, that would scare the crap out of me?
How low would the 10-year have to go for me to be truly terrified?
Yeah, where would the threshold be where you say the system will break if 10-year gets to X in the next 2 years? How low would that number be? Can it get to 4% without breaking?
Oh, I think a 4% 10-year would really be horrendous.
Right.
And the faster it got there, the worse it would be.
2 years is pretty fast. I think there'd be a lot of broken china on that one.
And the spreads would be a lot more than, another, whatever it is, 350 basis points north of here. The spreads would be, double that or triple that.
Right. The spreads, that's where the breakage would appear, right? That's you'd have, the 20% of the S&P that are zombies that can't pay their interest payments on their cash flow. What a disaster. Right? Those companies will get nuked. They'll be bankrupt.
Okay, so we've been talking for a while, so I always do the same final question, and I'm going to throw my final question at you and see what you do with it. If you could leave our listeners with one thought today, what would it be?
Don't believe anything you read. They're all lying. I don't know. I'm debilitated by that. My final thought is that the market's in a massive bubble. No matter what they say, by 20 metrics, the market's in a massive bubble, and bubbles have never failed to resolve. Never.
Amen. All right, Dave. Well, listen, thanks for being here, and thanks for your final thought. I think that's, straight and to the point, and I've said it, 10 times on this show, but it helps when I get back up from people like yourself. We'll definitely invite you back, of course.
Okay. Good to hear from you again. These are always fun.
All right. That was awesome. Listen, I love talking to Dave. I feel like when I have Dave on, we should just skip the mailbag, skip the rant, skip everything and say, hey, this is going to be a double episode, because what you don't realize is that we didn't get into 5 other topics that he's looked into fairly deeply. So, he's that kind of a guy. He's like a modern day Renaissance man. Really cool. All right, let's do the mailbag. Let's do it right now. An unstoppable force is taking over our country's financial markets. And if you have any money in stocks right now, you could soon see the effects in your retirement account. You see, stocks have soared over 70% since last year's crash. It's been one of the greatest rallies in American history. But according to my friend and colleague, Dr. Steve Sugarud, a far more dramatic financial event is on the horizon, and it could blindside millions of Americans in 2021. Go online to www.2021bullmarket.com to hear exactly what he's predicting and what it means for your money in the coming months. That's 2021bullmarket.com. 2021bullmarket.com. Check it out. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Just send your questions, comments, and politely worded criticisms to feedback@investorhour.com. I read as many emails as time allows, and I respond to as many as possible. You can also call our listener feedback line at 800-381-2357. That's 800-381-2357. Tell us what's on your mind. A light mailbag this week. First, we're going to start out with Jose A. Jose A says, just a new member. I am worried on the recent down market. Would be glad, I think, of your recommendations, he meant to say. Would be glad of your recommendations. Thanks, Jose A. Jose, first of all, there's no such thing as just a new member of the podcast audience, man. We're grateful for each and every one of you, including you. Thanks for signing up with us. Yeah, you're worried about the recent down market along with everybody else. Everybody's always worried in a down market. But my recommendation has not changed. Hold plenty of cash. If you're holding plenty of cash, if you're holding gold and silver, a little tiny bit of Bitcoin that you could afford to go to zero, and of course, your stocks and bonds, right? If you're holding all those things, and maybe you've got something else, maybe you've got some land, some real estate, rental properties, whatever. Maybe you've got a collection of Ferraris or vintage guitars or something that you know a whole lot about. Continue doing that. That is my recommendation. My recommendation is always specific to you. Know yourself, know what kind of investor you are, and work that. That's your strength. Your self-knowledge as an investor is your strength. It's a good question, though, and everybody's worried about the down market. Everybody wants a recommendation, and that's mine. Ludwig H., our longtime listener and very frequent correspondent, he says, is a long-term vision not something which is problematic in the investment world or real life? After all, does it seem that we are all focused on quick gains? Best regards, Ludwig H. Yeah, it does seem that we're all focused on quick gains. And the last couple of days, that's not working out too well, is it? Yeah, a long-term vision is hard. It's really hard. I mean, if you look at, you could look at almost anything. Look at Warren Buffett's track record, 50 years of I think he's slightly under 20% a year. I mean, wow. And you can't point to a lot of other people who've done that. Right? It's just rare. And it's difficult. It's difficult to hold on when asset prices fall. You really, really have to have a lot of conviction to go against the crowd. That's when you're going against the crowd. Most of the time you're just buying assets, and the market is not the most exciting place in the world. And then all of a sudden, whoa, the bottom's falling out and you got to make a decision. Part of the problem is that people don't know what kind of investor they are. It's an old adage that, traders become long-term investors in a bear market because people just don't like to sell. They don't like to take that loss. But traders take losses all the time. That's their job. It's the job of a long-term investor to know they're a long-term investor going in and to be able to hold. You have to know yourself. There is just no way around it. You can't straight up just follow anything. You have to know yourself to some degree. So, you have to make your own decisions. And if you're a long-term investor, be a long-term investor. Don't change. Because long-term works. It works in the stock market. We know that for sure. It works when, if your long-term vision is to own lots of great businesses that just pound out money and compound capital at high rates of return year after year for decades and decades. Yeah, long term is hard, but it's good. Good question, man. Just a basic question. Really good. Thank you. Next is Don B. Don B says, Dan, I never miss your podcast. Keep up the great work. Will you ever share a pic of yours? Regards, Don B. And Don B, the rest of his email was about Rick Rule. And Rick Rule was sharing lots of pics with us when we talked to him on the program. And Don is saying, hey, you ever share a pic of yours? Actually, Don, I've shared a lot of them. I think I've told everybody once or twice on the podcast and elsewhere that in Extreme Value, we've recommended Waste Management, the waste hauling company, Starbucks. I know I went public with that one at one point. And just recently, on this past Friday in the Stansberry Digest, which eventually becomes free, after a while they'll let anybody read it. But at first, when it first comes out, it's just for paying subscribers. We made our Extreme Value Costco recommendation public. We just published the whole thing just as it was published in Extreme Value. So every paying Stansberry subscriber this past Friday got that report for free, exactly as it appeared in the newsletter. We got a lot of compliments on it from all kinds of folks. And I thought, well, if everybody really likes it that much, I want to show the world. So we did. Which leads us to our next question. Oh, also, Don, remember, I've talked about Altius Minerals a zillion times, and it's been doing great lately, ever since they spun off Altius Renewables. And there are others that we've talked about. I just can't call them to mind at the moment. So, yeah, I've shared lots of pics, and we'll probably continue to do so over time. All right, next is Jeff K. Jeff K, he's our last question this week, and he says, good evening. Dan Ferris says to buy Costco. Louis Navalier of your corporate affiliate Investor Place has it listed as one of 10 stocks to sell immediately. How am I supposed to know who to believe? Jeff K. Jeff, that is up to you, right? Obviously, an organization as large as Stansberry that publishes all kinds of different people and different advice from different people using different strategies. I promise you what Louis Navalier is doing has nothing to do with what we're doing in Extreme Value. They're two completely different strategies. So it's up to you to figure out what to do with Costco based on what you know about the kind of investor that you are. If you think that, Louis's view of the world is more like your view of the world, maybe you're not bullish, or maybe you're actually bearish on Costco. But if you think your view of the world is more like what we publish in Extreme Value, then hey, maybe you're more bullish on Costco. It's all about you, man. It's up to you, Jeff. It really is. You have to know yourself. You have to know what kind of an investor you are. I've gotten questions like this. I've been getting questions like this the whole time that I've been published by Stansberry. I remember the very first conference I ever went to. I forget what the stock was. I think it was POSCO. It's funny, we're talking about Costco, and that was POSCO, the Korean steel company. And I think I was still long the stock. It did pretty well. We got a triple-digit gainer out of it. And I think maybe Steve Sugarud had recently sold it because he was trading and cutting losses and doing the thing that he does, and I was buying value and holding for the long term and doing the thing that I do. And a guy at a conference walked up to me and says, "What's with POSCO? First you bought it, then you sold it, then you bought it, then you sold." He went back and forth. I said, no. I've never said sell it, and Steve has bought and sold. He's traded it. And he said, and he just walked away mumbling. He said, yeah, you bought it, and you sold it, you bought it. So in other words, people have a hard time figuring out that Dan Ferris is not Steve Sugarud or Louis Navalier, and Louis is not Dan or Steve, and Steve is not Dan or Louis. You get it? So you can't, you can't say that what the Stansberry view is. The closest we have to that are the portfolio products run by Austin Root. If you want to know what the Stansberry view of a given stock or bond or something is, look for it in those portfolios. And, if it doesn't appear, maybe Austin doesn't like it enough to include it right now, or maybe he sold it recently or something, right? So that's the closest we come to the Stansberry view of a particular stock at a particular time. Otherwise, it's up to you to know yourself, and who knows, how many different subscriptions to Stansberry Research Services you may have. The decision is yours. It's up to you to look and see what we say and think about what you want to do with your money at any given time. I hope that's a good enough answer for you, Jeff. I often feel like when I give this answer to this question, like I said, I've had it many times over the years, that it's unsatisfying. But it is what it is. I can't change the reality of the situation. It's a great question, though. I hope people continue to ask it. All right, that's another mailbag, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. We provide a transcript for every single episode, but sometimes it takes a week or so to get it done. Just go to www.investorhour.com, click on the episode you want, and scroll all the way down, and then click on the word transcript. It may take a week or two for that to appear. If you like this episode, send somebody else a link to the podcast so we can continue to grow. Anybody you know who might enjoy the show, just tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. While you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. Follow us on Twitter. Our handle there is @investor_hour. Have a guest you want me to interview? Drop me a note at feedback@investorhour.com. or call the new listener feedback line 800-381-2357 and tell us what's on your mind. That's 800-381-2357. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.